We are meeting over 1,000 companies a year to get to around 20 or so investment. And if we don't know the founders and we don't know the sector at all, it's very unlikely that we would or any investors would invest in that company. The vast majority of venture investors do not invest in.
Joanne, thank you so much for joining our podcast. And you are working as a general partner at Foundation Capital, and you have invested with your team in iconic companies like Netflix or Jasper AI. I'm so happy to talk to you because I would like to first understand how many startups are you checking out per year, and via what type of channels are they entering the deal funnel? So are they, and maybe you have some kind of percentages like 20% coming from introductions, 10% are coming from conferences, maybe some direct outreach or whatever type of method, so that I just try and understand how those leads are getting into your deal flow pipeline.
Well, thank you so much for having me. It's a very good question. I wouldn't say I have the exact numbers for you, but approximately we are meeting over 1,000 companies a year to get to around 20 or so investments as a firm. In terms of where they come from multiple sources. Some are founder introductions, so introduced by the founders that we've worked with or we have invested in. Those are usually ones that we pay a lot of attention to, right? Because they're from like a vetted source. Some of them are introduced to us by angels that we work with, because we're typically investing in pre-revenue companies. These founders oftentimes have not raised much money from institutional venture firms, but they have maybe raised some money from angels. So angels introduce us. We also do a lot of outbound. Our team will look at LinkedIn and look for signals of people starting a new company and reach out to them to understand what they're working on. I think there the hit rate is a little lower because you don't know what they're working on. You have to kind of understand what is it that they're working on and then go from there to see if there's a fit. And then it also comes from networks that we've built, like universities. So we've done a lot of work with Berkeley and IIT. We have done a lot of work with VPs of engineering in our Compass network, which are VPs of engineering at large companies who may also send us deals. So those are all different channels where the leads come from.
So if you are starting with oversimplification 1,000 in the beginning of or over the whole year, and you are investing into roughly 20 at the end of the year, in those 20 that you are investing, are they mainly coming from one or two lead sources? For example, maybe where you have already built up a relationship with, like, for 1 or 2, 3 years, or as you said, like founder introduced them to you, or is it really that maybe even a large share of them is just by simply sending you a cold email?
I think that there is maybe a higher concentration of founder introduced or angel introduced to investors that have been around a long time. And there's probably more cold outreach, cold outbound by investors who have been in venture for a shorter period of time, just because of the networks and whatnot. But I wouldn't say that it's consistently coming from one source, which means as an entrepreneur, to reach an investor, if you're raising money, there are many ways of approaching it, some easier than others.
And which ways would you recommend? So, for example, some startup founder who thinks, oh, he has some great MVP, has some kind of early traction. Maybe he's pre-revenue or has his first like 10K, 20K MRR or whatever. And he thinks like, oh, your foundation capital might be a good fit for me as a startup founder. How should he reach out to you, knowing that he does not have a network who has a contact with you? So would you just send you an email, or would you rather say, oh, the acceptance rate of this is quite low, maybe you should rather go for another route?
Yeah, I'd say that in the worst case, you could always approach on LinkedIn or send an email. Probably better on LinkedIn than email, because then you can see the profile of the person. And we are always screening profiles and whatnot. And certainly I respond to cold outreach to me if I think there could be a fit. I think when I don't respond, it's usually when I don't think there is a chance that or very good chance that we might find it interesting. So that's one channel anyone can access. The best channel would be to get a founder that we know to introduce them. So that probably takes a little more work. You might have to get to know a founder. You might have to find a way to, build a relationship and then get the introduction. But that introduction is very high intent and also high value. And so we pay a lot more attention to those introductions.
And if you look at the deal flow pipeline, like say from first contact to term sheet, whatever, can you walk us through the different phases and each scoring model that you're using, whether you're moving a startup to the next phase or not?
Yeah, the way that we think about phases, I'd say fundraising is like enterprise sales, right? For a
Mm.
founder. You need to find a champion, you need to find a budget holder, you need to go through procurement. Many firms have an IC, and all those steps are actually quite similar to
Yeah.
do an enterprise sale. And we all know enterprise sales can take a long time, and they're full of kind of unknown variables that go on behind the scenes. So it's just finding the right fit. Behind the scenes, the way that we think about the different steps, we have pre-screen, we have screen, we have diligence. And each step, typically what happens is that one person will screen the company, and if they're moving forward to the next phase, then multiple people will usually meet with the company to give an opinion. If we put a company into diligence, it means we're really doing reference calls, talking to customers or prospective customers, introducing to prospective customers and all that. And I think that is a phase that's a lot more work. In the first two phases, it's just more about the chemistry with the person. Do we see some vision alignment? Do we have a good conversation? And a more preliminary intuitive reaction to the opportunity. Once it goes into diligence, we write up a memo. The memo gets circulated. Depending on the check size, we either have the founder present at some point to a subgroup or to
Yeah.
the larger partnership.
Yeah.
And after that, we do a vote. Different firms think about voting differently. Some firms voting is purely advisory. Others is, you have to have consensus, or you have to have, certain number of yeses and nos, or no more than a certain number of nos. And that's how a deal gets done.
How's the voting process working at your company?
We have more of a advisory voting process because everything is pre-revenues. However, we do have subgroups that are very deep in this domain. So we don't have a formal kind of voting structure, but we do have a lot of advice, a lot of discussion for a particular investment. And typically, a few of us will effectively make the call.
So let's assume you will get a pitch deck or maybe even a financial model from a SaaS founder. How do you evaluate whether you really want to move forward with it? I mean, even in the first phase, are you just looking at very high level stuff, like, for example, what is the ICP, what is the target addressable market? Is there some kind of value proposition that you think is defendable and significantly better? Are you checking those things, or do you mainly look at what is the founder and his background, and then just think like, okay, we will find a TAM and ICP for that?
So at the stage that we invest in, which is predominantly pre-revenues and sometimes pre-product, the way we think about investing is very much focused on founders, right? Do we think these founders are the right team to do something exceptional in this market? Why they are who they are? What does their learning curve look like? What is the founder market fit in this particular case? What are their motivations? What are their capabilities? How have they evolved over time? We do a lot of work on the founders, and we want to see some kind of value alignment with the founders. That being said, I'd say that we also, in parallel, look at different sectors and topics. So we might do deep dive on construction and how AI is disrupting construction. We might do a deep dive on how sales tech is evolving, right? And we're doing these deep dives in parallel in the background at our firm. Oh, and when we find a set of founders that is working on a problem that we think is really interesting and where we have connections, then we match the two, and we may make an investment. So it's not evaluating companies on a one-off basis. It's really evaluating them in the context of what we already know about a sector. The reason why this is important is because some founders will come in and fundraise, and they may be working on a sector that we know nothing about, right? And if we don't know the founders and we don't know the sector at all, it's very unlikely that we would, or any investors would, invest in that company. But if we know the founders for a long time, but the sector is new, we're probably willing to do the work to figure this out. Similarly, if the sector is something that we understand and the founders are, new, we're also willing to kind of do the work to do that. We want to back companies in which we believe can be number one, number two, number three in the market. So
Yeah.
there's got to be something special about the way the team is approaching it, which we believe that could be true.
I
Yeah.
totally understand that you are taking or want to take smart risks, so that either you have some kind of insights into the market or the founder has a great market founded. How do you assess the capabilities of a founder if he is pre-revenue? He might only have a CV. Maybe he does not even have a working prototype yet, or maybe only has a launch. I mean, if I'm looking at the situation, yeah, you could check the CV or talk to him. But this is, I mean, you could get sold by a snake oil salesman. You're not just looking at the product or marketing strategies that you're already doing, or the process of how they think they will go to, for example, 50 million, 100 million ARR. How do you assess the capabilities of a founder?
There's a couple ways to deal with this. One is we do a lot of reference checks, so on the person. That's like a very important part. And oftentimes with these pre-revenue companies, we will spend possibly 3 to 6 months getting to know someone and working with them before we invest. So through that period of time, we can see, hey, do they do what they say they would? Do they learn very quickly? Do they make a lot of progress? And that is like a really interesting proxy for how we think about, do we want to invest in someone or not?
The key learning here is basically, if I'm a founder and I need to raise money the next 3-4 months, it's highly unlikely to get a good seed investor like you, because first you want to build like a relationship, know how the founder is making progress so that you can estimate his capabilities, right?
Well, it's not highly unlikely. I think it's absolutely possible. We've moved very quickly and done deals very quickly, but the bar is higher.
Yeah.
Right? The bar is higher from a resume standpoint, from a maturity of idea standpoint, is higher when they're coming in and saying, "Hey, I want you to make a decision in 2 weeks."
Yeah.
Right? Then that's a very different way that we evaluate versus they say, "Hey, I'm brainstorming. I want to work with you. Let's try working together for a few months." That's a very much longer kind of get to know each other cycle where we get confidence. For first time founders especially, it's much easier to do the get to know each other for some time when there is an absence of a lot of resume.
And how would this work? So how can I imagine this as a founder? Am I just sending you, for example, like monthly updates on the progress I've made, and thereby we are building a relationship? Or is it that we would have like every month or so a short sparring call where you would be looking at my progress, even though you would not have invested yet, but you would then maybe give me some kind of tips and say like, hey, did you think about this, or how would you approach that, or how can I imagine this relationship to grow over this like 4, 5, 6 months period?
Yeah, I mean, I think that every single time we engage with a founder, we want to engage more if the interaction was positive, right? So we think there's something there. We think there's potential. The way that we do it tactically is sometimes we'll send prospective customers to these founders and see what the prospective customers might say, even if they don't have a product. We might get an update from them, and they may say, "Hey, like I have a product. It is, or I'm building a prototype. This is how much progress I made in the last 2 weeks," right? To look at the velocity. We may brainstorm with them on some kind of market and where the market is headed and stuff like that. So there's a bunch of different touch points that we have. Especially I think with very young founders, the velocity part is really what gives conviction, because then the thesis that I might have is, hey, this person is going to do this faster than everyone else.
Right.
And speed is certainly one vector of competition.
It's a very smart move if you're sending in potential customers, because first you try to understand what is the ICP of the startup that is in touch with you. Then you're sending them some ICPs. You are then basically doing two great things. One thing, you're helping the founder. He's getting some additional value from you. And second, it's a great validation for you of having a problem solution fit, because if the customer that you referred comes back and says like, wow, it's a great solution, then you have some kind of checkbox and saying, oh, maybe there's some problem solution fit out here. And if you're sending up whatever 10 ICPs over and 40% of them converting to a customer, then you think like, oh, not a bad problem solution fit. I should have a meeting with them.
Yeah, and even if the customers say, hey, like they don't have a product, but the way they're describing the product or the mocks are showing me, I'm very excited, right? Then I think, okay, they have found a problem that is worth solving, but maybe they haven't built it yet. So then my diligence could be, do I believe they can build it?
Now imagine like in 3, 4 months after your first touch point with the founder, you are convinced, oh, that's a great problem to be solved, great market, great founder. I would love to work with him. Now you have your 30-second time window of convincing this founder why he should work with you and not one of the other 100, 200 VC funds that are also investing in SaaS AI companies.
Yeah, I think that the relationship is almost pre-established in many of these situations, right? If we get to know someone for a period of time, we're making customer introductions, it is very likely they will want to work with us and continue to do so. I'd say 90+% of the time, that is the case. If we are
Right.
coming in and we are evaluating the company in 2 weeks and there's 5 other firms doing the same thing, that's a very different scenario, right?
Yeah.
So that's one thing. The second is that the vast majority of venture investors do not invest in pre-revenue companies. Most of them invest in companies after they have revenues, after they have some customer traction, after the companies have already discovered product market fit.
Right.
And we play before that, and we help companies go from pre-product market fit to discovering the first semblance of product market fit. And because of that, I think there's just not that many investors who are willing to do so. The third part where I think founders pick us is because we have a very high graduation rate from C to Series A, meaning over 70% of our seed stage companies, which is where we invest, end up raising a Series A. And that is a probability that resonates quite a bit with founders because they're in survival mode, right? They just want to get through the next phase before they go and raise their Series A. And we have done a good job helping them do that.
What is the typical deal size or ticket size that you're doing in the first round?
For the seed, I want to say between $1 and $6 million. We lead seeds. And then when they raise a Series A, we follow on as well. So we do commit quite a bit of money over time to a company. So we think of every single investment as a 10-year investment, not as a, we invest and then we go away. We oftentimes take a board seat and we're on the board, very active. And we do a lot of portfolio services work in the back end for these companies as well. So that's how we operate. Now, on the founder's part, I think that the most resonant reason is the stage in which we play and the kind of the tactical work we do to help them go from A to B.
How do you structure the deal? Are you sending the money in one bank wire, so to speak, or are you setting milestone-based tranches, even in seed rounds?
No, we typically don't do tranches. It's usually an equity deal. So there's, we price it with a term sheet. We invest, X million of dollars for X percentage with an option pool. And then we get equity for that. As part of that, we send the money, when it closes. So we send the whole entire amount. Sometimes we will consider tranches, but typically tranches are challenging because there's two aspects of it that doesn't work. One is we pre-agree on something, right? And a lot of things can happen. The market might change, the founders might feel differently, we might feel differently. So when the tranching happens and the second tranche is kind of due, it's almost never a perfect situation at that moment. And I also think tranching leaves a lot of room for error, especially as the market is fast evolving, and it doesn't. And because we're a high ownership investor, right? We target 20% ownership when we invest. It doesn't give us the ownership up front, so it's not great for us either.
You mentioned there's a pre-revenue startup, maybe some kind of AI agent company or so coming to you and pitching you, and you like the idea, but it's pre-revenue. And they are looking for like 2 million or whatever, which would equal at 20% like post-money valuation of $10 million. How do you go about that? Are you just taking this, okay, the people are looking for 2 million, which means 10 million post-money. Am I fine with this valuation given the market and team? Or are you trying to settle for some other negotiation or enterprise value? How does it work? Because you don't have ARR or multiples that you could be using for the valuation. How does it work?
I think valuation, the seed stage, is more of an art than a science.
Right.
And I think the part that matters to us the most is ownership. It's less about the valuation, but much more about the ownership and the corresponding check size we're willing to put at risk to get that ownership, right? From our standpoint. The reason why ownership matters so much for us is because our seed stage fund is $600 million in size.
Mhm.
And for me or anyone on the team to do a good job, we need to effectively return at least a third of the fund, at least.
Yeah.
Ideally more, but at least a third. So let's just say we return $200 million. At exit, the ownership gets diluted down. So even if we start at 20%, at exit, it may be closer to 10%. And let's just assume that it's close to 10%. A company needs to be worth $2 billion for us to return 200 million at 10%,
Right.
right? Which is why the ownership matters so much, because if we own 3% of the company at that point, then I have failed to do my job, and that's not a good place to be. So that's how we think about what is the most important. On the valuation itself, what I'm seeing today in the market is, first-time founders are commanding a lower valuation typically. They range, maybe 10 to 15 million post, something like that. The second-time founders are typically raising, at higher valuations. If you were a CEO, you sold a company, you had a good outcome, it could go into 15 to 20 to 25 million post. And obviously, when there's market dynamic and there's competition, perhaps valuations get a lot higher than that. In which case, we typically don't participate in something when it becomes what we think of as a little irrational. Also, the companies that are working at the foundation model layer have historically raised at larger prices. Today, maybe not as much because there's so many of them now, but historically have done that, and we have consciously not invested in foundation model companies by and large because of the capital intensity there. Right. And then the other part is like when companies have traction, they're also getting a lot of market demand. But again, we invest pre-revenues, so the competitive landscape is a little bit different. And as part of that, our valuations have stayed relatively flat. Our entry valuations have stayed relatively flat since 2016, 17 until today.
Okay.
So, with some fluctuations, but relatively flat.
So imagine you're now married into a startup. You invested money, let's say whatever, $2 million or whatever in the seed round, and now you're owning some equity in the company. How do you make sure the startup is growing as fast as possible? So do you have some kind of go-to-market strategy, guys? Do you have some kind of acquisition platform who can regularly push some ICPs, potential customers, into the sales pipeline of the startup, or maybe some other ways where you can boost the growth? Because if you boost the growth, then of course your equity stake will be absolutely more valuable once the company is sold.
Yeah, that's why we have a lot of portfolio services helping companies go from 0 to 1, right? Because our metric for success is that they go raise a Series A first. So as part of it, we have people on our team who are connecting customers or connecting design partners, and they have a target of how many they are going to connect for each company.
Okay.
So that's happening. Those oftentimes translate into deals, pilots and deals. And this is especially valuable for companies that don't have revenues, right? To get a VC introduction, and hopefully that converts into something. It's a big deal. The first million in some ways is the hardest, and we try what we can to help companies get there.
If you look at the landscape of SaaS companies or AI companies right now, and you did some kind of hypothesis on different market segments, value chains that might be disrupted with new technology, and you also see startups going after specific opportunities. What unmet opportunities do you think there are where you see like, wow, I'm so crazy. Why is no startup or is going after this opportunity right now? Can you share some kind of insights? Do you have some kind of opportunities? Because I talked to another VC the other day, and he said like, once I found a very nice spot in the insurance industry paired with data, but nobody was doing this startup. That's why I just found another founder, talked with him about the idea. He went after it, and then boom, sold for 1 billion. Yeah. So that's why I would love to learn about more of this unmet opportunities that you think they are out there, but apparently not many startups are going after that.
The function of startups or how founders pick problems is usually the problems they experience themselves.
Right.
Right. So if you think about, you as a employee somewhere or you as a professional somewhere, almost everybody experiences the problems of recruiting, maybe sales, right? These are very common problems everyone experiences as employees and whatnot. Very few people experience problems that are a little bit less known, right? So for example, the verticals, like, I have a company in senior care. Not many people have experienced senior care as an industry or want to work something there. Not many people have experienced what it's like to work in logistics, right? Because just not many founders are in that space. So naturally, there is a large number of companies around problems that founders have experienced and small number of companies where founders haven't experienced problems. And I wouldn't say those are correlated with market sizes. I think this is more correlated with human nature, with human psychology. So there's always an arbitrage there, right? The second is that founders are typically drawn to markets where there's large outcomes already. The replacement theory of software, right? Like something has been done, there's a budget for it. Let's just make something better and then compete with that. Fewer are drawn with markets in which they have to create the market because it is harder. You have to do better marketing. You have to convince someone to do something differently. And I think those markets tend to have much less competition. Not saying it's not possible, it's just less competition. Like imagine before Salesforce, there wasn't really sales software. Salesforce probably was one of the first to get to that kind of scale and demonstrate to the market that it can be done. Same with NetSuite, or in the database world, Oracle. And, now we have all these established players that have shown us the path, but at some point they weren't there. And I think that's probably where the opportunities lie, which is if you believe there is a market that is underserved because of the founder talent, but that has huge opportunity, we're always looking at stuff like this. And right now I'm spending time in a bunch of the verticals that are a little bit less sexy, the ones that have a lot of services historically, but that I believe AI has a opportunity to automate some of the services done by humans, and so translate the services into software. We actually wrote this whole blog post around the new SaaS, which is services as a software versus software as a service.
Okay. When I'm thinking about a company, I'm thinking like, okay, either you are really awesome at product, awesome at marketing, or really awesome at sales. Because I mean, in the best world would you, of course, if you have some kind of competitive advantage in all three of them, because then you're just a totally money-making machine, because all your conversions are looking like crazy. If you are in pre-revenue, of course, you don't have marketing insights, you don't have sales insights because there are no sales. So how do you evaluate or try to forecast the ability of building a great capital-efficient marketing and sales machinery for a specific product in a market?
We look for founders who we believe can sell themselves, right? Because the first step in going from 0 to 1 is that they have to be able to sell this without the help of anyone else. And I think even for the first 10 million, the founders tend to be somewhat involved with some of the selling, or a lot of the selling. The orientation we have is typically product and technically driven founders who can also sell. That's like how I think about a lot of the AI investing. And I think that's like one characteristic. On the marketing and sales front, as we're building out the teams, we do have recruiters in-house who are helping companies do this. And those are, people who are helping hire the first head of marketing or head of sales and putting them in our companies and seeing how they do.
But you do not plan up some kind of marketing or sales strategies. For example, if a company wants to enter a market and compete with one of the big dinosaurs in a specific way that's much better, and they say like, okay, our product is like maybe 20-30% better. That's okay, but not super awesome. But we think we have a marketing and sales edge because the other ones are, for example, using customer acquisition model like one. And we think like, okay, let's do oversimplification, maybe TikTok, whatever, if this would be working for this kind of customer segment. But and the other ones are not doing it. Or they would be using some kind of AI and automation tools, which maybe some others are not using, and thereby increasing the marketing efficiency by, let's say, 10-20x or whatever. So and then basically the hypothesis would be, okay, we have a good product, slightly better, but we are so capital efficient on customer acquisition, and thereby we will be taking market share. Is it something what you're looking at?
We don't see any of that.
Yeah. You don't see that. That's right. But the question is whether you pre-validate those things. I mean, even if they are not there, you could ideate, or at least the founder
Yeah.
could say, okay, our go-to-market strategy is like we would go through TikTok. Thereby, we think our customer acquisition cost will be like what 1/5 or whatever. We did some kind of smoke testing before that already, so that we have some kind of assumptions. We did not spend $100,000 marketing dollars on that, so in order to harden the data, but we have validated the assumptions as good as we can. Yeah, so because I mean we are not raising money just because we want to raise money, but because we have a good use of that, and not only product, but we have some kind of ideas on what marketing channels we would like to spend money on in order to grow from 0 to maybe 1 million or beyond.
I think our first revenue goal for the company is 1 million, obviously, but then there's 10 and there's 100, right? So,
Yeah.
and then 100, we have to believe the companies can still grow at 50% year over year. So that's how we think about like the revenue goals. Some companies get there by investing heavily in direct selling, especially the larger deals where you need more hand-holding, consultative, implementation, that kind of stuff. Some companies do this by investing a lot in marketing. And the sales are more order takers as marketing is driving leads and activity. And some companies are doing a combination of both, which is the vast majority of companies. This also depends on what the deal sizes are. Sales is, on a per headcount standpoint, you can argue maybe more expensive than marketing because you have a one-on-one kind of dynamic where marketing could be one to many. I think different companies and different products do this differently. And in my opinion, any of these strategies could work, but there's got to be a reason why that strategy is well suited for the product that they're trying to sell and well suited for the market they're trying to go after. And some founders can say, hey, like I've innovated on the go-to-market part because my thesis is that, this has been a traditionally sales-driven industry, but I'm going to do a lot of marketing efforts to get the attention of people and sell to them there. That's fine. Now the question is that possible? Is that doable? Especially in markets where there hasn't been a lot of software. I think there's this orientation of like, let's just do like direct selling, but more and more companies are doing more marketing to kind of educate the market. It just really depends on the specific situation. We're open to all of it. I mean, open source is the ultimate, let's give everything for free. And then let's try to create an enterprise product and let's try to sell the enterprise product. It's one of the hardest business models in some ways. Whereas like, selling enterprise software one after the other is some of the easiest.
If there's a founder standing in front of you, what are the top 3 tips that you can give him if he's looking for, let's say, $1 million and he's pre-revenue?
A lot of the work is around figuring out which investors will care. Venture is not transparent. So what investors are looking for, what they're thinking about, what firms do what, is not very well known. The things that founders can do to figure some of this out is, do they have investments in this category, but not too directly competitive because then that precludes them. But things are adjacent, that they have seen success. Are they talking about it publicly, about some of these topics? If so, that's probably a good sign. They're looking for stuff like that. Are venture investors, have they been looking at other types of companies in the space, right? And if a founder is able to find investors where they're already educated, the chances of them raising money from them goes up by 2-3x. It's an orders of magnitude difference. I think that's like the most important thing is like the ICP identification of that. And I think the second part of it is, it's not that every branded firm is the right fit for every founder. Sometimes founders don't have very much. Maybe they should raise a few $100,000 from a bunch of different investors. Those are all credible options. So I think thinking through like what they have and how the market might perceive them and who they should go after first, the sequencing of these conversations matters a lot. Because if you're going out and raising from, let's say a large branded firm and you have no revenues and your pitch is not very good, you're not going to succeed.
Of course. Yeah.
But you might start off with raising from a micro VC that has $20 million fund that is writing, 250K checks, and they're looking for something like this. That might be a really good first start, right? And then you kind of save the VCs for later. So those are probably two things tactically from a fundraising standpoint that I think founders don't do that well in general because they don't understand, how the market might perceive them. So it's probably worth having conversations with a few investors, ideally friendlies, to give them the feedback that's honest.
And the last question, what do you think is the biggest aha moment of founders where their expectation of working with a VC is totally different once they are working with a VC?
There's always some element of that because VCs are salespeople and they're selling their services, right? And then, what happens after the investment is a very long journey. It's 10 years. So even how they perceive and work with a VC on year 1 versus year 5 is dramatically, different possibly. Reference checking other founders is probably helpful, especially in tough situations. How do VCs navigate tough situations? Do they just ignore you? Do they, do they start being difficult? There's a bunch of things that they, that is worth kind of diligencing.
Yeah.
And I do think VCs, just like any other channel, if you want to get utility out of VCs, the founders have to be proactive. Like the founders have to think, okay, I'm trying to sell these deals. Should I reach out to my venture investors and ask them for help? What can I make it so that it's easy for them to help? How can I incentivize them to help? It's not a, hey, you raise money from me, you're just going to actively help. Not all investors are doing that because we have, 8, 10 portfolio companies and we had to work with a lot of them and we're looking for new deals. We're fundraising. We're doing a lot of things. We're writing content. We're doing podcasts, all sorts of other stuff. So managing the venture relationships matters just as much. Don't assume the investors will just help.
I mean, it totally makes sense. I mean, the founder should be at the driver's seat and then say like, okay, guys, I know you invested in a new company who might be an ICP for me. Could you do an intro for me? And just send you a quick email of saying like, hey, Joanna, I saw you did this, or do you know somebody here? Can you make an intro? Or maybe I have some kind of idea. I would like to have like 30 minutes of your time. Can we briefly think this through because I'm maybe feeling stuck in that. Maybe you can provide some kind of input. Yeah. And then it's still driven by the founder.
Absolutely.